Introducing our next speaker, who's going to be joining us on a line, Michael Blakey. Let me tell you a little about him. He's the managing partner and co-founder of early-stage venture capital firm Cocoon Capital. Now, Cocoon Capital adopts a hands-on, founder-first approach to early investing. And Michael's also a veteran angel investor, and he was named UK Angel Investor of the Year 2015 and was also selected as one of the Maserati 100, which is classified as a business angel that you should definitely know about. Now, what he's going to be speaking about is the common mistakes founders make post-investment. So this should be pretty interesting as well. I keep saying that about everybody, but it's true. It's all very, very interesting. So without any further delay, let's move on to Michael Blakey and let's learn a thing or two.
Hi there. Thank you very much for having me. It's an honor to be able to talk at Disrupt Wired. I'm here to talk about some of the mistakes that I've seen over the last 20 years of investing, of mistakes founders make after they've actually raised the funds. Sometimes so much focus is done on just getting the money into your bank account that the relief kind of washes over you after you've achieved that, and then you forget that the next step of your journey is starting. And so I'm going to talk about three of the most common mistakes that I've seen. In particular, I'm going to focus on seed investing. So after you've raised your first money, either from angels or from a seed fund. As very kindly introduced, I've been an investor now, both as an angel and as a VC, for 20 years. I've directly invested in now over 100 companies across the US, Europe, and now Asia. So kind of like jumping in, one of the, I think probably the main mistake that entrepreneurs make after they've raised money is they forget about the investors. You spend a lot of time whining and dining and getting the investors to invest in the money. And as soon as you've got their money in, you kind of move on to what you would say is running your business, which is obviously the most important thing for you to do. But you've also got to remember that a lot of investors bring more than just money to the table. Quite often, they are very well connected. They've had a lot of experience. You know, for a lot of founders out there, it's your first time setting up and running a business. So most investors have seen a lot of the common mistakes that are made by founders, and we can help you avoid those. So I always say that, you know, as a founder, when you raise money, your expectation is that you're going to have to do a lot of trial and error, and you might actually end up wasting about 40 to 50% of the money that you raise purely on experimentation and trying to do things in a different way. If you use the experience from your investors, you can actually find that you maybe only lose about half that amount of money on experimentation, because a lot of times they can actually help you avoid mistakes that, you know, other companies they've invested in have made. Also, what I find is that it's not really talked about a lot at events like this or within founders themselves. But even some of my most successful companies have had to do bridge rounds. Things haven't always gone according to plan, finding the product market fit, or you might suddenly have a big customer suddenly delay payment, and you might have a cash flow issue, and you have to do, it's seen as a negative, but I don't see it as a negative, a bridge round. And what you've got to think about is that if you suddenly, and normally a bridge round is done by your own investors. It's very hard to raise money in an emergency from outside parties. So normally who you have to go to are your current investors. If you haven't talked to those investors for months or over a year, and you suddenly call them up out of the blue and say, hey, we've got this problem, the likelihood of you actually getting money from them is much lower than if you've kept them up to date on a regular basis. Now, you don't have to kind of call them up and meet up with them every month. what I normally suggest the best way to do is have a weekly or a monthly or bi-monthly newsletter, which you send out to your investors, just giving them an update of what's going on, both the good and the bad. And also if you have any asks, like you're trying to do a deal with Unilever, and does any of your investors have a connection in there that might make it easier? That in that way, you're building that relationship with the investor. So if there is an emergency, they are more likely, that they become more connected to what you're doing, and they can see the journey that you've been on, and not suddenly have this random call come out of the blue asking for money. And it's amazing how many times you find that one of your investors has a connection into a company that is amazingly helpful for either your BD or your supply chain or something. So as I said, so the key thing is post-investment, make sure you keep open communication with all of your investors, as a minimum on a bi-monthly basis. I normally say on a monthly basis, and a newsletter I find is the best way of doing that. The second one is that up until you've raised the money, you've been 100% in control of your business. You've been able to do whatever you want to in terms of the decision making. You haven't really, as founders, you haven't really reported to anybody. When you take on external money, and in particular in VC money, there's also a level of responsibility that you actually take on, and there's a lack of control. A lot of founders are very much focused on, we have 50% or 60% of the business, so we control it, we can do whatever we want. The reality is that investors, we have, if you're investing in equity, you have minority protection. You have things that there's a certain level of reporting and responsibility in terms of what you can make a decision on your own and what you can't. A lot of that is driven through the board. So sometimes it does slow down the decision-making process. And a lot of founders can get very frustrated by saying, oh, let us run the business, give us your money, let us run the business. And we know what we're doing. For me as a VC, I've got responsibilities to my investors who back me, and I've got to make sure that the company is running and doing things in the right way. So, the word that no founder really ever likes to talk about is like corporate governance. Have a proper running board, setting up, all your financial reporting, do business or do business strategy plans, forecasts for the next year. I've never in my 20 years ever seen a company be successful that hasn't actually put in some basic corporate governance into their business when they've raised funding. It doesn't guarantee success, but I can pretty much guarantee you won't have success if you still kind of run it on a more ad hoc basis when you've raised funding. And one of the things that I've always found as well is sometimes founders are very fearful of when they're talking to their investors maybe at the board, is not to talk about the concerns they've got or the issues that they actually have within the business, until normally it's too late. They're like, we don't want to disappoint our investors, we don't want to worry them, so we'll try and figure it out, and then come to them. And if they can't, by the time they actually bring it up to the investors, sometimes it's too late to handle. Experienced investors, when we invest in your companies, we know that what you're trying to do is you're trying to build a new business. You're trying to do something outside of the norm. The likelihood of you getting it right the first time is actually very low. We understand that, and our job is not just to give you money, but is actually help guide you. And we can only do that if we actually know what the problems are. When we invest in the money into your business, it's not our money anymore. It's the company's money. So I've had one or two founders in the past saying, oh, we didn't want to take that risk because we don't want to lose your money. The reality is, as soon as we put that money into the business, it's the business's money. It's not our money. We understand the risks that we're going into. So you can't have the fear of failure and just say, we don't want to disappoint anybody. You've got to take the same level of risks that you were taking before. So as I said, communication is just a very important thing, and don't be frightened if things don't work. Don't fear. We can't talk to people. So I think that's another area that you've got to be aware of. And also, when you take external money, you've got to understand in many ways the clock is ticking to an exit. And this is where sometimes founders don't fully appreciate, especially if you're taking money from a VC. I was an angel before I became a VC. And as an angel, I'm investing my own money. I think the longest investment I've held now is for 17 years. And I exited a couple of years ago. And I was fine with waiting that long. But if you take VC money, you've got to understand that there's an expectation that you're building, and there's a clock ticking as soon as you take on that, and you've got to expect that the VCs are at some point in time going to be asking, when are you looking to actually exit or formulate an exit for us, if not for the whole business? And so the expectations, and the more money you raise and the higher valuation, I would say the expectations are grow. And one of the manifestations of this is up until you've raised your first money, you've had to kind of take every dollar that you've had and actually make it last for like $5. And then all of a sudden you have money in the bank. So the acceleration that you've got to go through actually increases. And sometimes founders find it very hard to actually start accelerating because they've got money. They still they're so used in their mind to being cautious and managing costs extremely tightly. When you've got more money in the bank, I'm not to say that you go out and you start signing ping pong tables and you start spending it in an uncontrolled way, but the acceleration of the business there is a level that is expected. And so working at the different pace is I think is something that founders really struggle with. I'm just thinking, there's some comments that are coming in. All right, okay. The Q&A is after. So one of the areas that I find actually helps founders after you've raised the money, we make all of our companies do what we call a 100-day plan. So, and whilst we're doing due diligence before we close, we actually sit down with the founders and we say, what are the key things that you want to achieve in the 100 days? Because that's something that you have control. Worrying about what's going to happen in 12 months' time, there's too much fluidity. But quite often when you're raising the money, it's to hire a number of new people, it's to build out the product, it may be to launch your product. So working on a detailed 100-day plan, and it just cover very much like the HR, the marketing, the product. So it doesn't have to be a huge number of things. And you break it down, we find into like 30 days. So it's, we call it 100-day, but reality is it's over 90 days. And figuring out what are the key deliverables you want to actually achieve over that time post-investment. And I think that really helps kind of focus founders on what they need to do as soon as the money's in the bank account. Because I'm sure there's lots of founders actually sitting out there and saying, well, fundraising is pretty much a full-time job and it can take you 6 or 9 months to raise the funding. And within that time, the plan that you are presenting probably has changed dramatically to the one that you're actually going to do because of the time. And because you haven't been involved so much in running the business, sometimes you have to get your feet back under the table and get on top of things that might have slipped whilst you were focusing on fundraising. Because very rarely do you have people in an early stage company that can kind of cover for one of the founders, and normally it's the CEO who's running the business. So I think, setting up so just kind of like covering kind of some of the main things that you can do to actually alleviate some of these risks is, I think, having a regular newsletter with all of your investors, setting up a proper board and identifying which are the best people to be on the board. A lot of founders are very much, we just want people who are going to agree with us. I actually think it's best for you to find people that will actually challenge your thinking. If you have the choice of who sits on your board, and I admit you don't always have that, the role of somebody like myself being on a board is I'm always there. I'm going to be supporting you because obviously I've just invested in you, but I'm there to challenge. I'm very much play the devil's advocate and make sure you've thought of all the different options. And then the last thing I would suggest is just doing this 100-day plan to actually kind of help you really focus post-investment on what you want to deliver. And what some founders actually do, they then do a rolling 100-day plan, because it just really helps them kind of really focus on the key deliverables in over the next 3 months that they've got to achieve. So on that time, I think I've just about run out of time, but hopefully that's given you some kind of areas to be aware of post-closing, and some of the ways that you can actually overcome those risks to make sure that you give yourself the greatest chance of success post-investment. So I'm happy to take any questions that people may have for me.